Welcome to Coverage Over Coffee, hosted by AI Mutual. I am Agent Ivory, and here we talk about various insurance topics in a fun and informative way that is easy to understand. Enjoy hot coffee and delicious pastries with like-minded people that are excited about creating generational wealth for their families. Don't forget to like, subscribe, and share the channel. Today we have a very special spotlight for you, featuring my beautiful B1 sisters, B1 Butter Biscuits B3 Company. Just Eve and Gladys did an amazing job on these tasty biscuits.
Shout out to both Eve and Gladys for collabing on B3 for the B1 Butter Biscuits. These look so delicious. Looks like I have blueberry, minis. Okay, looks so good. Look at that, it's gonna be tasty. Raspberry and red velvet. All right, can't wait to show you this to you all and taste them. All right, so we have Ivory here, and which flavor did you get? The red velvet? All right, let us know what you think. How you like it? Very tasty? Would you recommend them? All right, awesome, thank you so much. So y'all heard it first. The cookies are super delicious. Definitely go online, check it out, get your order in today. Again, they have all these delicious flavors. So if you like chocolate, they have something for you. If you like the jelly filled, the raspberry here is so good. Red velvet. I love the fact that they have a variety of flavors, right? Sometimes not everybody is a chocolate person or a vanilla person. Of course, they have blueberry. And then just go ahead and top it off with your coffee.
We are giving B1 Butter Biscuits B3 5 stars for their quick delivery, great menu selection, and thumbs up that we received from family and friends who tasted them. In fact, one of my neighbors texted me and stated they were fabulously delicious. So, order your biscuits today and tell them AI Mutual referred you. So today we're going to talk about life insurance. This month, as you know, is Life Insurance Awareness Month. I love to talk about this conversation every year. Definitely check out my past recorded shows and interviews, being a guest on other people's show. Either I'll drop the links of those, or you can actually just go back on this platform here. But definitely want to inform everyone who may be new to this channel about life insurance. So we're going to talk about everything. We're going to talk about the history of life insurance. We're going to talk about the importance of life insurance, and then take a deep dive into some of those products so that way you can determine what product is best for your family. So let's get started. So a little bit about the history. The insurance industry has a very complicated history with the Black community, okay? Slavery rests at the foundation of American capitalism and is often synonymous with the sugar, tobacco, and/or cotton plantations that fueled the Southern economy. Several insurance companies benefited from slavery, including New York Life and AG. New York Life found that its predecessor, Nautilus Insurance Company, sold slaveholder policies during the mid 1800s. So, what are slaveholder policies, you're asking? Slave insurance involved a contract between a policyholder and an insurance company in which the insurer promised to pay a sum of money upon the death of an enslaved person. In the 3 decades leading up to the American Civil War, so that would be between 1861 and 1865, such policies became widespread in Southern states. Policies were sold for $375 to $600 on the life of each slave. A 1906 history of New York Life says 339 of the company's first 1,000 policies were written on the lives of slaves. AIG also insured the lives of slaves. Later, once African Americans, I always like to say Black Americans, were free from slavery, insurance firms would deny coverage to the Blacks requesting policies. They felt the lives of free Blacks were somehow more difficult to assess than when they were slaves. During the Jim Crow era, insurance companies would charge Black Americans higher rates for life insurance than their white counterparts. Black men and women have just not been able to receive a fair experience when it comes to life insurance policies. Restoring the trust or relationship between Black America and the insurance industry. So everybody remembers 2020, right? That's kind of like when our world as we know it changed. In late May, national outrage erupted over the death of George Floyd, who died after being detained by Minneapolis police. The video image of ex police officer Derek Chauvin with his knee on Floyd's neck as Floyd pleaded for his life became the catalyst for social uprising in America and sparked a global movement towards change. The insurance industry had been criticized in the past due to its lack of diversity and the racial bias that follows it. But in 2020, as protests swept the nation, insurance companies started to join in the Black Lives Matter movement towards racial equality. So, as you can see here, these were some of the things that they wanted to do to right the wrong. So here it says righting one's wrong. Mutual of Omaha, and this is all in 2020, announced that they would remove the Native American imagery from the logo. Also in 2020, numerous insurance companies stated that they were going to make amends to their clients and employees. So how they were treating their clients, how they were treating their employees. I know that there were some firms who were not allowing Black Americans to advance like others in the company. So they were like, hey, we're going to do something about that. We're going to have better representation on our boards and our C-suite. Has that really happened? Well, it definitely happened in 2020. Some of it didn't happen, and we're still waiting for those changes, okay? But just wanted to let you know that 2020 did shine the light on the complicated history between Black America and the insurance industry. So, what is the importance of life insurance? So, as you can see here, there are many benefits to having life insurance. First and foremost, I always tell everyone, all my clients, your funeral is your responsibility. So, as you can see here, the first thing that we have listed is pay final expenses. You want to make sure that your funeral is taken care of. You have lived a long life, you've worked very hard. You want to be buried according to your standards, not anyone else's standards on how you should have the last view of your life. Okay. Next, pay off debt. Unfortunately, that doesn't go away. Cover children's educational expenses and not just college. I know a lot of people are definitely thinking about college because of those student loans, which is important. However, if you have kids that are, younger in elementary, middle school, or high school, you know that they have a lot of fees associated either the summer camps or maybe the camps throughout the school year, or if they're in any type of sports that's very expensive if you have to travel across the country, go to tournaments, different contests, things of that nature. So you want to be able to keep your kids in those particular events or sports in the event they lose someone significant to them. That way they can stay engaged and mentally they can stay, have a great mental health during that stressful time. Another one, pay estate taxes. This would be great to do using the funds from a death benefit. Your death benefit. Also, replacing spousal income. So, in this world, normally, if a family has a two household leadership there, I should say, or if it's led with two people who are married, paying the bills, then as we've seen, inflation is through the roof. So 9 times out of 10, that household is being ran on to incomes. However, sometimes there just may be a breadwinner. So one person who is in charge of all the finances for that household. In either scenario, being able to replace that income is extremely important. It's definitely important if you are if you only have a household that has one person that is responsible for all of the debts, and liabilities. However, even if it's two people in a household, if one person loses their job, or excuse me, one person passes away, now that family is still taking 10 steps back because now they're having to run a household just off of one income. And then here, lastly, buy a business partner shares. So, generational wealth. This is one thing that a lot of people don't talk about in the insurance industry, but I love the fact that with your policy, that funds from that death benefit can be used to create generational wealth for your heirs. And yes, I do mention the word heirs, offsprings, and descendants. I love using those words. I try to use that at least once a week, if not once every day, because I want to make sure that I remind myself that I have a responsibility to leave something for the next generation. Also, it's good for you to remind yourself that you are an heir because you should also be receiving something. Something should be being passed down to you. So, again, let's start with that. Speaking of being passed down, pass wealth down. Pass wealth to your descendants, heirs, and offspring. It only takes one person in your family to make a huge and forever difference. Next, rich people have life policies. I've listed some here. These are just examples, but did you know that Warren Buffett, who is worth $80 billion, and of course this number changes all the time, but he owns several life insurance companies and has many life insurance policies on himself. I actually read that he takes out several every year. Very genius to him, right? I'm sure he does that for tax advantages, because once you receive a life policy or your beneficiaries receive life policies, they do not have to be taxed on that. Okay, so that's very genius. But I'm sure he has his reasons, and I'm sure he also has whole life and term. He wasn't very specific on what type of policies he had, other than he just stated that he does get several life policies every year. Also, Nipsey Hussle here. At the time of his tragic death, he was worth $8 million and was insured for a $1 million life policy. So even though he was a millionaire, he still understood the importance of getting a life policy. And because he was young, I'm sure he was healthy, he was able to get qualified pretty quickly as well as pay very minimum for that policy. As a result, that $1 million went to whoever he listed as his beneficiary, probably more than likely very quickly. That $8 million estate probably had to take a little bit of time in order to be settled and given to the proper heirs. So definitely, you want to make sure you have a life policy, even if you're rich, so funds can get to your beneficiaries very quickly. So building wealth. So as you can see, we want to make sure that our foundation is the way that it needs to be. Okay. And so down here, life insurance would be considered your foundation. Why do we call this your foundation or wealth protection? Well, as you can see listed here, life insurance, death, total permanent, disability, critical illness, disability income insurance, health insurance, mortgage insurance, wills, and trust. This is considered your wealth protection. In the event anything happens, you have to be able to replace that income. So you can't move to any of these other tiers if your source of income is lost. So we always consider that our foundation. So you want to make sure you have a strong foundation and purchase these products. The next one up would be wealth accumulation. And here we have speculation, growth and diversification, and savings and accumulation. Let's start with savings and accumulation. So this would be to, your regular savings, retirement funding, education funding, home ownership, emergency fund. All right. And to the right, you see lowest risk, lowest earnings. Let's keep going up. Growth and diversification, investments, bonds, stocks. You have your trust here. Keep going up. Speculation, under investments, your property, Forex, futures, commodities. And then at the top, okay, it just says your wealth distribution. And this is where you're going to have your highest risk and highest returns. But at the end of the day, we have to make sure that foundation is created. Just like when you build a house, you can't just, hey, let me go throw on a roof, right? Throw on a roof on what? You have to make sure you have a strong, solid foundation in order to be able to build up. So, zero wealth by 2053. This was very alarming news when I first heard this in 2020. So, this is Andrew Yang, who is a Democrat hopeful for the presidential office on a Democrat ticket. And he mentioned twice, once on the Breakfast Club, and then again during a primary Democrat debate, that African American net worth would be $0 in 2053. So one thing, it was a lot of alarming things that he said in this, right? One thing to me that was very interesting is that we haven't heard this from any of our quote unquote Black leaders in all this time, okay? And that was very concerning, especially from our political leaders who have say so in laws, and that could actually help us create generational wealth. They're very silent on this issue. So to have an Asian person who knows this information and come on I would say predominantly Black radio station, because their audience is mostly Black, to give this information and stat was very alarming. And then again, to go on a national forum, during a debate and say this was also alarming too. And what was interesting was that none of the other hopeful candidates disagree with him on this. So they all are aware at the top, the 1%, they're all aware of this information. Our government's very aware of this information. Everybody understands that we're headed to zero in 2053 and no one's doing anything about it. So, since we cannot wait for them to do something about this for us as a collective, now we're going to keep pressing them, especially on reparations, things of that nature that are owed to us. And of course, to receive that equality that we deserve, in our neighborhoods and on so many different things when it comes to real estate and everything else. We should definitely keep pressing for that. However, we still have to take the reins in take control of the reins. And so I want everyone to start creating a plan on how you're going to ensure that your family will not become this statistic. So since Reconstruction, our wealth for Black Americans was at 2%. And it's a little bit lower now to 1.5% because of COVID, how it just, canceled 50% of our Black owned businesses. Now, of course, people since then have opened up more businesses. However, that just can't compare to businesses that have been open for a very long time. And now, due to inflation, they are projecting that many more businesses will be closing at the end of this year. We're not talking about 5, 10 years from now. They're talking about this year. So we have to make sure that we have it together on our financial front to make sure that our families will be okay by 2053. So one thing that we're going to have to do is just grow up financially. All right. So we already saw the pyramid on how we need to have a house in order from the bottom to the top. But now we're going to have to grow up financially when it comes to life insurance policies. We have to stop paying for funerals, right? With these items listed here, we see it all the time on social media, and it's really sad. And I understand that families have to do what they have to do. If someone doesn't have a life insurance policy in place, they don't have the money to be able to pay 10, 15, $20,000 in some cases for a funeral. So yes, they will have to put up a GoFundMe online, or they will have to go ahead and do a fish fry or a car wash, or ask people to donate on their Cash App. But this is not the correct way to do things. I know people are doing it, but this is unacceptable. This should not be our first choice, or any choice for that matter, in order to pay for a funeral. At this time, we all have access to be able to get life policies. We saw the disparities, we saw all of the issues that we were having, before as Black Americans when it comes to insurance. However, now it's equal opportunity, for the most part, to be able to get a life policy. So it's up to us to be able to get these policies. Preferably would be when you're young, when you're healthy, right? When those premiums is the amount that you pay is really low. But if not, that's okay. You can still get it later. You're just going to pay a little bit more. So some things we should definitely be focused on is our health. I know they always want to talk about education, but really, in high school, we should be focused on our health, because that takes everything. If we're not healthy, we can't go out there and make wealth, right? So we have to be healthy to be able to create that wealth, to be able to take care of these policies, to be able to take care of our generations to come. So now we're going to go into take a really quick deep dive into the different types of life policies that are available. Because we want to make sure that you are paired up with the correct product for you and your family. So the first products that we're going to talk about are term and whole life policies. So let's discuss term. So term, or sometimes you'll see temporary policies. I always say this type of coverage is great for people who are younger, who are healthy. You receive more coverage for less money. Please note that there is no cash accumulation in a term policy, but that's okay. All right. Term, it's a fixed time period. So term policies are for a set period of time, such as 10 years or 20 years. So before 2020, 30 years was pretty much the max. But since then, now some companies are offering 35 years and now even up to 40-year terms. So that's pretty amazing. If you can actually get a policy at age 30, that means you're going to be good until you're 70. So you know that your premiums will not change. So that's really good. It's a level premium. Again, your premiums, you're locking in that rate. As we have seen, inflation is through the roof now. So people are starting to see why it's smart to go ahead and lock in these rates, because whatever your rate is today may not be the same rate come a year from now. I mean, think about it. A year ago, we were not paying almost $10 for a 36 count of eggs. Like, this is what we're paying today. That's unheard of, but this is where we are. And my question is, how much are we going to be paying for eggs this time next year? So the good thing about life insurance, unlike eggs, is that you can actually lock in your rate, okay, and be able to control that. Conversion. Some policies allow you to convert to a permanent product or a whole life policy by a defined age. Usually, this should happen at age 65 or 70. Sometimes they may say 2 years prior to the end of your term. Okay. Again, there's no cash accumulation in a term policy. Riders. So you can always add riders. But one thing that's pretty cool is that the accelerated death benefit is included in most policies. And what that means is for any reason, if your health was not good, well, let's just say it was failing and you only have 12 months or less to live, you can actually get some of your money out, okay? Some of your cash out of your term policy. You would, of course, have to supply a doctor's note to your insurance carrier, and usually there is an administrative fee, maybe $250. Every carrier is different, so check your policy. But it's a really great option to be able to tap into maybe up to 25% of your policy, because now maybe you wanted to always travel the world, or maybe you wanted to do something for your grandchildren. So now you have those funds to be able to live the last remaining months of your life the way you want to live that. Okay. And there are other riders available for an additional fee per month. Term with return of premium. A lot of people don't know about this. So this is a very great option for people who do want to accumulate cash. Yes, you can accumulate cash in a term policy with return of premium. It has to have that on there, okay? So yes, so that is actually an error that actually does accumulate cash, okay? That was a copy and paste error on my end. But it does accumulate cash in this policy. Again, everything's going to be the same for a term policy, but the difference is now you have an endowment benefit rider. Remember I was talking about those riders? Well, now this particular product here includes the endowment benefit rider. The premiums actually are going to be paid for in your rider, okay? And I always say up to the first maybe 5 or 6 years, there's no cash accumulation, but after that, it starts to accrue cash. I always want to see it. Sometimes they say, with this particular product, you can get 100% of your premiums back. If you towards the end of your term, right? Let's say you got a 30-year term, it's almost year 30, you're still alive. You're like, hey, look, I want my premiums back that I paid into the policy. Now, they do market it as 100% premiums returned. However, when I did look at it and read it, you're getting up to close to 96% of your money back, which is still not bad, right? Because those who just have a term product only, they receive $0 back. So that's really good. And then another great thing too is, let's just say you had 30 years and you're like in year 15 and maybe you have some other insurance policies or maybe you accumulated wealth some other type of way. And by year 15, you're like, you know what? I don't even need this policy anymore. I just want to go ahead and cash out. You can do that. You can you just call your insurance company and request to see how much cash you have accumulated at that point. I actually do provide an illustration that gives you an example of how much cash you can accumulate, every so many years. So that way you'll see that. But that's pretty awesome, so that way you can cash out, if you needed to earlier. And let's talk about final expense now. So now we're moving on to our whole life products. And again, final expense, everyone should be able to take care of their funeral. Of course, with the term with return of premium, you should always allot some of that money out, okay, to be able to take care of your funeral. But for those who just want a product that's pretty much only for funeral and associated expenses, that would be considered final expense, okay? It's less coverage for more money. Usually, for final expense products, they go up to 40,000. I'm starting to see some now up to 50,000, but no more than that, right? Usually, they start as low as $5,000 increments on up, to 40 or $50,000. That is supposed to be enough to cover all of your funeral and associated costs. Again, cash is accumulated in this product. All right. It says that this length of product is good up to age 120, although now a lot of insurance companies are going down to age 100. So I guess we're just not living as long now. So just definitely read your policy for the correct information for you. And then also, this is really good, no medical exam. This is great because, again, we all need to be covered, with insurance. So in most cases, no medical exams are required. Yes, you can borrow against the cash value on your policy, but what I always want to stress to any of my clients who purchase whole life insurance, doesn't matter the product, always please be careful. You don't want to take out or borrow more money than you can pay back, because at the end of the day, the whole point of life insurance is to be able to leave money to your heirs. So you don't want to be upside down. They're having to pay that loan back, plus come out of their pocket to pay for a funeral. That's just not a good look. So definitely, you can borrow against your policy, but just please know that all outstanding balances, interest, admin charges, etc., will be subtracted from the death benefit before being given to your beneficiaries. Next one, graded death benefit. So another one that's a really great option for those who may not have the best health would be the graded death benefit whole life policy. With this also, you will receive less coverage for more money. The time period again is up to age 120, but a lot of it has been dropped down to age 100 now. So just double check again. Usually it's from $5,000 to $40,000. The max, no medical exam. You can get approved very quickly. The only caveat with this particular product is the probationary period. So for the first 2 years of the policy, if you should pass away, this is going to be due to a health reason, the beneficiary will only receive the payments from the premiums that you paid into the policy plus 10%. Now, if you passed away the first 2 years from an accident, then it'll be treated like accidental insurance and the entire policy will pay out to your heirs. Now, after the 2 year probationary period, it doesn't matter how you pass away. It doesn't matter if it was an accident, doesn't matter if it was health related. Your beneficiaries will receive the full death benefit amount. And then a traditional whole life that most people do know about. This was on the scene first before term. So that's why a lot of companies later came out with buy term invested difference, because traditional whole life was just expensive, but that was the only option people had. So, a lot of people had traditional whole life and then they were able to get term. And then that difference, people were able to invest in the stock market, which was doing very well. And then, always I tell people just be careful. Sometimes that phrase works. Sometimes that phrase does not work, just depending on how our economy is and just depending on like we're having high inflation now, the stock market's not doing too well. You just have to kind of check your own pocketbook and your goals to see what's going to work, which product works best for you. But traditional whole life is good for those who do want to accumulate cash, who would also like to borrow against their cash. You have that option here. And then also people who just may want to lock in their rate until age 100 or 120. They don't want to have to worry about conversions and deciding on, switching policies, when they get 65 or 70. So that's really good too. Some cases, it could be no medical exam, but since 2020, you guys, being honestly, everything is pretty much a medical exam. They leave the door open, I should say, now to say possibly. When it used to be back in the day, when I say back in the day, prior before 2020, they used to say no medical exam. That was it. But now they say a possible medical exam if you have not had a doctor, if you hadn't been to the doctor within 18 months, right? Some of them, a lot more are now just requiring medical exams. They just want to know what's going on. They know a lot has happened in the last few years. Insurance carriers, this is just a side note, insurance carriers have definitely felt a lot of financial loss from what has happened in the last few years. So they definitely are reviewing insurance applications with a lot more scrutiny. Okay. So the insurance process, this kind of ties into the insurance process. So, how to get a life insurance policy? So, the first thing that I always like to let people know is what the carrier looks for. So, the insurance carrier look for the below when deciding on insuring applicants. The first thing is they look for a steady paycheck, right? If you cannot prove that you can actually pay for the policy and then also for the amount of the policy that you want to obtain, that's an automatic decline. Like that's the first thing that they're looking for. It's a steady paycheck. They're also looking at your health record or the MIB report. This is a high level medical record, okay? But they definitely look for that. They also look at your driving record. They want to make sure you don't have any DUIs or DWIs. Also, looking at your RX report, which is your medicine history. Medicine can tell a lot about you. If you're taking high blood pressure medicine, then they know that you could possibly have some high blood pressure or high cholesterol issues. So that's why they look at that. They also look at your credit in some cases. Most insurance carriers do not. However, there are some insurance carriers that will pull a soft pull. And I do like to inform my clients that it does not affect you if you're trying to purchase a house or get a car, anything like that. It's not going to show up on your credit report. This is the soft pull. Okay. And then also, lastly, they're looking for honesty. Once they pull this information, they pretty much already know about you, right? They just want to see if you're going to be honest and let them know the truth about you. And one thing that I don't have on here that is new now and is starting to go state by state, so it's not on national yet, but your social profile. Carriers will now look at your social profile to determine if they want to insure you. So everybody, please be careful what you have on your public, I would say, profile. If you're just showing yourself drinking and eating all greasy food and doing all these dangerous activities like skydiving or drag racing or anything like that, they're probably not going to insure you. If you're showing yourself working out, eating healthy, that'll be fantastic. If your 10-year, former picture looks, I would say, looks the same as you do now, then I'm like, okay, this person's going a correct way. However, if you look worse now than you did 10 years ago, they may be like, man, what's going on? So you just want to make sure that you're putting your best foot forward on social media as well as on your application, okay? So how to get approved? Again, they're looking at everything. They're looking at your lifestyle. Okay, so if you're asking for a huge policy and it doesn't reflect your lifestyle, they may have some questions. Doesn't mean you're not going to get the policy, but they may have questions. And usually, with every submitted application, you will have to do a 30-minute interview, is what they like to call it, or intake. So that way they can make sure they're speaking to a real person. They just want to cancel out any type of fraud that may occur when it comes to a life insurance policy. So they actually want to speak to, the applicant, the person who's trying to get insured. Ask you questions, verify some information that's on your application. If they have questions at that time, they'll ask you that. Okay. Also, your health history. Okay. Again, taking a health exam in last year or 18 months is really great. If you haven't been in 10 years, they're probably like, what's going on, right? But you want to make sure again that they have the information that they need. In some cases, they may have to pull medical records if they don't have what they're looking for. That could take a lot longer, and just kind of dropping it down here into the insurance process, right? But most of the carriers can make a decision pretty quickly. But what you need to do is just to make your application, which 9 times out of 10 can be online, depending on the product. I do have some of my I would say more, I don't really want to say elite products because anyone has access to them. However, I do have some products that my more wealthy clients will obtain, and that does require a lot of paperwork. Okay, but pretty much any other type of products can be purchased online. Okay, and then also that teleconference, right? So you're going to have that tele interview on the phone, and then also the medical screening. If they need for you to take a medical exam, they can actually come to your house. So how convenient is that? They would just set up a time, come to your house. They would draw your blood. You would do a urine sample. And then they will also verify your height and your weight. So with this information, they can determine if they want to go ahead and approve you um, for a policy. So let's just say you are approved. Okay, fantastic. Some things to do once you have been approved is to keep your policy active. I tell people all the time, your beneficiaries cannot get paid if you pass away and your policy was inactive. So what constitutes as a policy going inactive? Well, if you had premiums that were paid monthly, and it depends per state, but most states will allow a 30-day lapse period, right? Or grace period. And then after that is considered lapse. Okay. So, because everybody knows things happen, so sometimes people even will change their banking or financial institution and just forget, to contact their life insurance company to switch everything over. So you have 30 days to do that. Now, after 30 days, it's up to the insurance carrier's discretion to cancel, but they have that right to cancel. Okay. So keep your policy active, because even if you pass away in that 30 days where you did not make a payment, your family will still receive a payment from your policy. But after, like on day 31 or day 32, depending on how many months, is in that calendar month, then they would not be paid. Okay. Also, you just want to keep paying all your premiums on time. Inform your beneficiary, okay, your primary and your contingent beneficiary about the policy. Nowadays, you can actually email them a copy of the policy. But even if you don't, or just don't want to email them a copy of the policy, please at least email or text them or print it out and have it listed somewhere where they know to get it in your home, so they can have access to it in the event you pass away. They definitely need to know the insurance carrier's name, your policy number, the death benefit amount. Okay, as long as they have that information, that could really help them be able to file a claim in the event of your death. But congratulations, your policy is enforced, your family is protected. And this is what we're doing here in the month of September. We want to make sure that every family is protected. Okay, we want to make sure every family can create that generational wealth. And for the generational wealth information, that's a whole nother ball game, right? And I do have some more podcasts on that, so check that out. Definitely review that, because we want to show you guys how to put everything into place to keep this financial success going for years to come.